Hey, good morning, everybody, and welcome to this Tuesday, May 20th, 2025 edition of Trading Places live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. It's a pleasure to be with all of you again this morning. Another day, another green day in the market yesterday. I thought that was kind of interesting, especially given the fact that U.S. credit downgraded on Friday. And we saw the market start off pretty weak yesterday, but we battled back. And all major indices recovered quite nicely. They didn't all finish green. I think small caps, mid caps had a little bit of difficulty on a relative basis, but still, we did see a nice bounce back. One thing that maybe has gone unnoticed now, but for 3 days in a row, we have seen defensive areas of the market perform a little bit better on a relative basis than the aggressive groups. And that's a little bit of a change. I don't know. Could be kind of marking a short-term top. We're going to talk about that in just a couple of minutes. I can tell you, I'll go over the futures real quick, though, and just give you a kind of a sense of what we're looking at this morning. Right now, we got the diamonds up, or excuse me, down. They were up earlier, but they're down just fractionally, down 16 cents to 427.88. So we're only talking about 4/100ths of a percentage point. The spider, which of course tracks the NASDAQ 100, down about 0.2%. The QQQ tracking the NASDAQ 100 is down about 0.35%. That's down $1.85, so back down to 520. We did set a new high, a new recent high on the QQQ yesterday, closing at 522.01 after opening earlier in the session at 514 and change. So it was a big gap down, but then a recovery, got it all back and ended up in positive territory at the end of the day. But to me, those are a little bit of weakening signs when we see money rotating into more defense. Even with that rally back yesterday, it was not a big push back into technology or consumer discretionary. So we got some issues there. The IWM small cap this morning is relatively flat. It is also down 4/100ths%, similar to the Dow. So that's what we got as we open up a new trading day here in about 25 minutes or so. And, we'll just take it another day at a time. But I do think that we're starting to see some signs, in terms of the rotation that make me a little bit more nervous in the near term. We already have sentiment issues that I'll show you in a minute that are pretty concerning. So we'll see what happens, and I'll show you some key support levels. But let's go ahead and take a look at the action from yesterday. So we had the Dow Jones Industrial Average finish up 137 points. And again, you can see over here on the left side, the big drop in the Dow and then the recovery. We'll look at each of those as we go through here. Here's the S&P 500 finishing up 5 points for the day. Doesn't seem like much, but when you consider we were down at the 5,900 level, maybe even slightly below at the open, to rally back and finish at 59.63 and keep that winning streak alive, I think is something to recognize about what happened in the market yesterday. NASDAQ up 4 points. It too had that big drop, and it also rallied back to barely close in positive territory. But looking at the mid caps, you can see the mid caps finished down about 1/3%. Big gap down. We rallied. We just didn't make it all the way back. Same goes for the S&P 600 small cap index. Big gap down. Rallied back, finishing near the high of the day, but still down about a little bit more than 0.5%. Volatility index was up 5% yesterday, even though the market was up. So it's just telling us, market maybe, we haven't been able to get through that 16 level to the downside. And that normally, well, not normally, in every bear market so far this century, every time we've had a bear market, when we get the VIX down below 16, that bear market's over. There have been no exceptions to that. So we have, kind of watching that. We got down to about 17, almost to 17, not below 16, though. And now we got the little fear ramping up. So what I would say is, while I still remain very, very bullish the market long term, I think we're going back to all-time highs. We're not quite out of the woods yet short term. I wouldn't be surprised. I mean, I've been saying this really for the last few hundred points on the S&P 500, but we could have a pullback at any time. And again, for me, because I do believe we're now uptrending. The key test is going to be at the rising 20-day moving average and a couple of other gap support levels that I'll talk about in just a couple minutes. But anyway, that's kind of where we stand looking at the major indices. When we look at the sector drill down, this is just for yesterday, but you can see healthcare up almost 1 full percentage point, utilities up 0.4%. Then we had industrials, consumer staples, materials, real estate. Those are the 6 top groups, and none of them are technology, consumer discretionary, or communication services. Those are the 3 really aggressive groups that we want to see lead the market. That's what's been leading the market back to the upside. So I think, we want to pay attention to those 3 aggressive groups. And after you get past the 6, then 3 of the next 4 are those aggressive groups. We had communication services yesterday gaining just 0.1%. Technology, even though we did have a rally back throughout the day, technology still winded up losing ground on the session, and discretionary, same thing. So, we've seen a lot of strength in discretionary versus staple stocks of late. And I'm talking about maybe the last 6 weeks or so. But yesterday was not one of those days. You can see staples actually green and discretionary stocks red, totaling about 0.5% difference between the two. So just a little bit of rotation more toward defense. Again, I'm not screaming that we're heading back down and going to go retest the lows, but it is, a sign in the short term, maybe of a little bit of weakness in the market, even though we set a new high. It's not quite the way we want to set that new high. S&P 500. So here are a couple of things to think about as I look at this chart. Some of the things that come to my mind. First of all, we've had this huge push in the PPO, which is awesome. So we've got bullish momentum that is accelerating to the upside on the S&P 500. So that's a good thing. I mean, we've got, price action. We haven't quite got back to where we were back in January and especially in February when we set that final high on February 19th. But, we have had almost a straight up move. And if you look at the last, 4, 7, 9, 13, it looks like probably about 19 trading days. The last 19 trading days, I don't see a single day with a filled candle that amounts to anything. I mean, this one right here, you got a little bit of a red filled candle telling us that not only did we finish lower than the open, but we also finished lower for the day. And if you look back, there have only been a couple of these red days in the last 19. It looks like maybe 3. I see 3 out of 4 as we opened May. But other than that, we just keep moving higher and higher and higher. So I find this to be very bullish. There's been very little distribution. This is total accumulation. Look at the last 6 days. 5 of them clearly have hollow candles. The other one looks like more like a doji, like it opened and closed at about the same level. So again, I'm seeing really bullish action, bullish momentum. But just here in the last couple of days, the leadership seems to be switching just a bit. And I'll talk about that in just a minute. But the other thing I wanted to point out here too, look at these black arrows. Do you see these 3 previous black arrows right here? These were all basically tops in the market. They also coincided with the RSI hitting 70. And look at what we just did yesterday. We closed at 69.97 on the RSI. So RSI is getting overbought. Now, one thing in a bull market advance, overbought can remain overbought. In the case of the fourth quarter tops, we were starting to kind of get a little frothy, started looking a little toppy, and then it became very toppy in January and February. We had a lot of things that we went over back then. I'm not going to rehash all of that right now, but we were getting close to being toppy back in October through December. Just so happens that it's a very strong time of the year historically, and we once again had a very strong period. But once that bullish period ended, which was the end of October through about the middle part of January, you can see we had a really nice rally there. Once that was over, and we started seeing some other signs of rolling over, rotation becoming an issue because we saw it moving more to defensive groups. Sentiment was a problem in the near term. a lot of complacency building as we had these tops in play. So all of that led to what we saw February through early April. But now we look at, like, this looks like a completely different market with a lot of momentum to the upside. Still some short-term issues, and one of those is the RSI overbought. I did want to point out back in June of last year, when the RSI hit 70, you can see that for the next 3-4 weeks, we kept going higher. So this is a case of overbought becoming more overbought. And that's always a possible move, or a possibility, when you're moving up in a secular bull market. So I don't rule out the market going higher. In fact, I believe in time, that's exactly what we're going to do. But if you're a little bit nervous about the market, you've been sitting on the sidelines, you're saying, hey, is there a chance we're going to come down? And if so, what are some levels? Yeah, I think the risk is starting to increase a little bit, that maybe this is the time for a pullback. I thought it might be last week because of options expiration. We seemed to go right through without any problem with options. And then the Monday after options expiration historically is the worst day of the year, or well, definitely the worst day of each month. I guess, if you added them all together, technically, I guess it would be the worst day of the year. My point is, you generally don't want to be in the market on the Monday that follows option expiration. I would, even though I don't have the study on it, I would say when you're rallying into option expiration Friday, my gut feeling tells me that the Mondays following that are probably even worse. So yesterday was a day we got the gap down. It looked like, we were probably beginning to roll over. We put in a lower low, a significantly lower low by $1 or $2. And I'm talking about the QQQ, by the way. Here, the S&P, I don't know, we were probably 10 points lower, something like that. But that was an opportunity for the sellers to get control. Like I said, it was the Monday following option expiration, which typically is not a good day. So we had all these reasons to go down. The market still fought back. Secular bull markets are really hard to bet against, especially once a bottom is printed. They tend to rally back very quickly, especially when they go down quickly. We saw what happened in the pandemic in 2020, March, April of 2020. Or actually it was February, March. February, right around almost the same timing in terms of top. I don't know if it was February 19th, but maybe it was February 21st. And then we went down to March 23rd. In this case, we went down to April 7th, but very similar. It wasn't quite as drastic a move this time. I think last time it was like 28% on the S&P 500. Maybe it was more than that. Might be thinking about the 2022 cyclical. Maybe it was 35%. I don't remember what it was, but it was definitely a bigger drop back in 2020, but similar in style, and that went down over a very, very quick period of time. But in 2020, I said it was not a secular bear market. We were still in a secular bull. It was not a financial issue. It wasn't a financial problem. It was a healthcare problem, and that we were going to go right back to all-time highs, which we did. I had similar feelings about this one. Talked about, you wanting to get out before the top ever hit. Talked about the fact that it could drop. I was looking maybe for a 10% correction at the time. Turned out to be a 20% cyclical bear market. So it was a little bit worse than what I expected. But it was right after the 7th is when I started writing to members saying, hey, you want to be in this market. You do not want to be out of this market. The risks have shifted to the bears. And so things were lining up much more for the bulls. Anytime the market pulls back 20%, that's a good time to be thinking about getting into the market. I don't care how bad the news is. You should be thinking about holding your nose and jumping in, because that's what markets do. They go down, they come back. Anyhow, so RSI, a little bit of a problem, a little overbought here. Definitely, the rotation that we're seeing. Let's talk a little bit more about that rotation. So this is just a 5-day chart of the S&P 500. So each one of these, this would have been last Wednesday, last Thursday, or no, this would have been last Tuesday, last Wednesday, last Thursday, last Friday, and then yesterday, Monday, where we gapped down and we rallied back. Technology relative to the S&P 500 topped middle of the day Thursday last week, and it's been going down ever since. even though we rallied yesterday, it was not a rally in technology in terms of relative strength. So we're seeing, some money rotate away from technology into some of the more defensive areas, which is a problem, or at least it can be a problem. And I think this is a short-term problem, not a long-term problem, but still, it's a problem. Consumer discretionary, it topped. We have to go back to Wednesday in the morning last week. That was when consumer discretionary topped relative to the S&P 500. And we're still much closer to the low than we are the high. Communication services, and this is the three aggressive groups now. Communication services Thursday morning topped relative to the S&P 500, been working its way down. Industrials, meanwhile, have gone up. Financials over the last 3 days have been more sideways. It might be slightly up from where we were, say, last Wednesday at the close. Slightly higher, but overall, not really a lot of buying. But look at healthcare. Healthcare, more defensive. Look at staples, more defensive. So you see how on a relative basis, money is rotating away from aggressive and back into defensive? Always makes you wonder, especially when the market's setting a new high. Now, we don't have a lot of the longer term issues that I was worried about back in January and February, but we do have short-term issues. And I'll get to those in just a minute. Actually, I'm going to get to those, one of them right now. So here's the S&P 500. And you can see at the bottom right here in April, we had a spike in the equity-only put-call ratio. And spikes mean that more and more traders are buying or trading puts as opposed to calls. And so when more and more puts are being traded, it kind of gives you a sense that retail traders are getting a little bit fearful, maybe even a lot fearful. And when retail traders start to panic and we have capitulatory type days like we saw these 3 days going down and finally hitting that capitulation on April 7th when we got down to under 4,900, went to 4,835, and then snapped back that day more than 250 points or 230 points, printing a hollow candle, and that ended up marking the bottom. 2 days later, we had one of the best days in the history of the market, second best in the history of the NASDAQ. But that all came off of a panicked reading in one of my favorite sentiment readings, which is the equity-only put-call ratio. Now, tops are a little bit more difficult to call. Just about every single time you get a spike to the upside in your equity-only put-call ratio, they almost always coincide with a market bottom. Could be a short-term market bottom, doesn't necessarily have to be a long-term, although when you get this and you get the VIX up in the 50s, which we don't see very often, those tend to be more longer-term type of bottoms. That's why I don't think we go back down below that. I think, the fear level at this point, we've seen a lot of the things that caused the fear, the uncertainty about inflation. There's been no bad inflation data out. The uncertainty about stagflation. Well, right now, as far as I'm concerned, people are just throwing it around. They've thrown it around before in the past. We have no evidence of stagflation, zero evidence of it. The tariffs, everybody obviously was worried about the tariffs, and for a good reason. I mean, we were kind of throwing tariffs out there like they were, I don't know, Skittles or something. It was just every day. It would seem like there was more back and forth. We were putting tariffs on China. China was retaliating. We were, putting tariffs on Europe. Europe was retaliating. And then we had, the Fed talking about inflation, and now we don't know what to do. Economy's weakening, and some people are worried about a recession. At this point, jobs still remaining okay. We got a pretty good jobs report last time out. It's like a lot of the uncertainties have been relieved. And as a result, we've seen not only the market move up, but fear move down. And fear is a major ingredient in a bear market, which is why when the VIX goes back down below 16, bear markets die because there's no fear. There's not enough fear to drive. It's kind of like, you're out camping and you got a fire going, but you run out of wood. Eventually, if you don't put some more wood on the fire is going to go out. And that's what happens with bear markets, that the fear runs its course. And once the fear has run its course and there's no more folks to sell, we turn back to the upside and we begin another leg of this secular bull market, which is what we're doing. But I will say, even though we've got very low complacent readings, I can tell you that the low complacency readings are not nearly as reliable in marking tops as the fear and panic are in marking bottoms. And that's generally the case with just about any type of sentiment indicator. Because, I mean, it makes sense. People don't panic buy. I've heard people, I go over to my club golfing and a lot of folks over there, we talk about the market. And I hear a lot of people talking about, oh my gosh, the market's getting crushed. I can't take anymore. I got out or I'm getting out. But I rarely hear about people, saying, oh my gosh, the market's gone up so much. I just can't stand it. I'm going to go borrow money and put some more money in the market. I mean, there are some that do that, got margin, got a lot of folks that do like to use margin, but it's not the same sense of urgency when the market's going up. People feel good about things, but they're not rushing out to buy more and just keep adding in a frenzy. To the downside, it's a frenzy. When you start seeing your portfolio drop by 3 to 5%, 3 days in a row at the opening bell, and you see all of a sudden 10, 12% of your worth disappear in 3 days, you start to panic a little bit. You don't want to go down another 12% in the next 3 days or 20% in the next 5 or 10 days. And so that's what your mind is focused on. All the news, of course, is out there. The media is, it's all bad news. Everything's horrible. Market's going to go to zero. Doubtful the sun ever comes up again. That's the kind of things you hear. So it's very easy to sell into all that hype. Those days right there were the days actually suggesting that we were bottoming. So the same days that were sending a lot of folks panicking out of the market, unfortunately, were days that were telling me the market was bottoming, especially from the 7th on. Here we kind of went down and we were finishing at lows, but a lot of that selling was still coming at the opening bell. But here you can see the big reversal, and then 2 days later, the huge hollow candle. And even days after that, when we would go down, look at the tails. See how these on the way down, we were just kind of finishing on the lows. Here, when you have a tail to the downside of the body, it's telling you intraday low was way down below, but the close came up and we finished well off the lows. So there was afternoon buying. That's what I talk about when I, refer to like manipulation in the market. It's when we're in panic mode, but most of the selling is first thing in the morning. It's either at the open, usually at the open, and then maybe for another 30 to 60 minutes, maybe 90, but usually by 10:30, we probably hit bottom, and then we start to work our way off of that, and that's where the buying starts coming in. So everybody's panic selling, which means volume spikes. Look at the volume. I don't make this stuff up. Volume was doubling. How do you think Wall Street gets in? Wall Street gets in because there's such a panic and there's so many people selling. It's easier to accumulate shares. And so that's what you have to look for. That's what we looked for. That's what we talked about. Talked about the bottom being in, just like back in 2022. I did the same thing in June, but I had a lot of folks, not as many this time, because I think folks have followed me for a while and they saw what happened in 2022. And so maybe they're a little bit more confident that the same thing would happen in 2025. But back in 2022, I mean, I was lambasted for calling a bottom in mid-June. People were like, how in the heck, you can't possibly, we're just starting to see rate hikes, just had a big rate hike in May of 2022. And, we got inflation problems. This is like the 1970s. And, back then there was talk, of stagflation, where we had growth start to come down and we had inflation building. Never panned out, but hey, it's worth talking about because it gets you lots of clicks and lots of views. Anyway, so that's sentiment. So just, you have to understand that sentiment has definitely turned. We were very, very panicked in the options world back at the low, but now we're very complacent. This is a very complacent reading. Any 5-day moving average that goes below 0.55 is starting to get complacent. That's just based on history. Here, when you start talking about 5-day moving averages at 0.47, 0.48, those are really low readings. meaning that there are a lot of calls being played, a lot of folks in the options world betting that this keeps going to the upside. And now we've got a little bit of rotation telling us not so fast. And I don't know, this seems like, again, I think calling the market short term is much harder than calling the market long term. I'm very convicted that this market's going back to all-time highs. I said it in April. I've been saying it since the bottom. I'll keep saying it. We're going back to all-time highs. Short term, I mean, what's going to happen today, later today, or the next 3 days? Your guess is as good as mine. I mean, I can look at this and say, hey, the risks are increasing. But last week, I thought the risks were high, that, the bulls needed a break. We needed some relief in the market, and the max pain was going to be a perfect time for it. And yet look at the 5 days last week. Not like we flew, but we did finish on or near the highs every day and continued to march to the upside. So again, risks are higher that we could see a short-term pullback, but I can't guarantee that. My long-term tells me we're going higher. Short-term, watch that rising 20-day moving average. If we do pull back, that's where I would look for that recovery. Also, I think back on this chart, I put in the gap supports. So you can see gap support 5,800, gap support, I don't know what that is, maybe 5,670. The rising 20-day moving average right between those two at 5,713. So that's kind of the range of support that I see. If we were to pull back, that's where I would look for us to find some support and turn back to the upside. All right. This is a long-term chart. So, if we do turn back down, and short-term, we've got some signals telling us that we might. If we do turn back down, I think there are 4 groups, 1, 2, 3, 4, that would likely benefit, at least on a relative basis. And those are healthcare, consumer staples, real estate, and utilities are 4 defensive groups. Now, when you look at the market over the last 10 years, S&P going up, and then you look at the relative strength of these 4 defensive groups, healthcare is way below where we were 10 years ago. Staples, way below where we were 10 years ago. Real estate, way below where we were 10 years ago. And utilities, below where we were 10 years ago, maybe the best performer on a relative basis. Now, that doesn't mean these groups haven't gone higher. They've gone higher. It's just that when the S&P 500 goes up in a secular bull market advance, the leadership comes from the aggressive groups. The leadership comes from technology and discretionary and communication services, and to some degree, maybe industrials and financials. Those other groups, on a relative basis, take a hit. They don't keep up with the S&P 500. They may go higher. Most of the time, they do go higher when the market's going up, but they don't go up as much. So if you want to beat the S&P 500, you need to beat it with the groups that are beating it. It's hard over the last 10 years to beat the S&P 500 return by holding a healthcare stock, especially one that's in a more defensive area like pharmaceuticals or healthcare providers. Those would be areas that I would be, really concerned about holding longer term, unless you're just in it for the dividend, which is understandable if you are. I get that. But just understand your reasons for being in those. But as I go down, I want to show you the correlation, the direction of, or the correlation of the direction between the S&P 500 and the relative strength of these defensive groups. So when the market goes up, I'm going to just show you the correlation here with healthcare. You see all this time spent down here between minus 0.5 and minus 1? That's telling us that most of the time, healthcare does not perform well relative to the S&P 500. In other words, it goes opposite the S&P 500. So most of the time, the S&P is going up, and most of the time, healthcare is lagging, most of the time. When the S&P goes down, the inverse still applies. So when the market goes down, stocks that would benefit would be stocks that are in areas like healthcare, because money rotates back to defensive groups when the market's going down. So that's why we see a lot of negative or inverse correlation and very little positive correlation. That's healthcare. If you go down to staples, look at this, same thing. Rarely do we even turn positive on here over the last 10 years. We remain very negative and many times very close to that -1 level, meaning that just about every time that the market goes up, staples underperforms. Every time the market goes down, staples outperforms. That's what this is telling us. Next up, real estate. Real estate spending a lot more time in negative. It has some positive in here. I'd say the correlation is a little bit more mixed with real estate. Real estate will lead a little bit more often. And then we get to utilities. Utilities rarely gets up into this blue shaded area, which is positive correlation, and spends a lot more time down here in inverse correlation. So if you want to know the best 4 areas to be in when the market's going down, it's generally the 4 defensive areas. Doesn't mean you're not going to lose money. It just means usually you'll lose less money. And sometimes you'll go up when the market's going down. But that's kind of a little bit more of a safe haven when the market's pulling back. So if you're looking for leadership during a correction or during just a normal market pullback, normally you're going to see that in the defensive groups. All right, for those of you that are new to earnings beats, first of all, please like the video. I mean, if you like what we do and you like our free shows, hit that like button. It'll really help us. And especially what will help us is subscribing to our channel. And when I say help, I'm talking about in terms of our algorithms at YouTube. We're trying to build a bigger community at YouTube. That will help us. You have no idea how much that will help us, even if you can't afford our service or for whatever reason you decided not to take us up on some nice offers that we've had here recently, last few days. And for whatever reason, I don't know. But if you like what we do on the show, hit that subscribe button. Please subscribe. Hit the like button. Those things really do help us in our efforts in building our community. The other thing you can do that is of no charge, you can always start a no cost 30-day trial to our service. That's going to require a credit card. But we will let you know before your 30 days is up that you are coming up. You're going to expire. You're going to get charged. Not only are you going to get charged, but we're going to give you a really good annual special to help save money if you want to continue your trial and continue the service. But that's up to you. We'd love to have you. Next 30 days probably going to be pretty critical on whether or not we're pulling back, whether we're breaking out. Be a great time for a no-cost trial. But at a minimum, if you're not already subscribed to our free Earnings Beats Digest newsletter, sign up. It is only a name and an email address. There's no credit card required. These are articles that are published 2 days a week, Mondays and Wednesdays, normally talking about things that are important to us, whether it's relative strength, could be something on seasonality. It could be a short squeeze candidate. It could be a stock that maybe is hitting an earnings gap, maybe a trend line, moving average. It could be all kinds of different things that we like to teach and to talk about. We also write about, just reinforces a lot of good habits, I think, in the market. So make sure you check that out. We'd love to have you on the Earnings Beats Digest as well. All right, it is 9:33. One thing I wanted to do was I was going to go through and talk a little bit about the strong earnings chart list. And if we do start to see some pullback in some of the aggressive areas, one way that you can maybe look for defensive candidates to trade, maybe make some money on those, would be to pull up, our strong earnings chart list. We've got this in summary form. I have clicked on the scooter column, which is Stock Chart's technical rank. It's a relative strength kind of system. But you can see the highest numbers are the best performers out there. You will see one of them. Here's healthcare provider stock, HIMSS, which I can tell you is also becoming a very, very popular short candidate. The short percentage of float on HIMSS shot up here recently. So a lot more folks taking the short side there. But anyway, one thing we can do is, let's say, okay, market starts to roll over. We don't really want to be in all the aggressive areas that have already taken a huge move to the upside. Those are stocks that likely would pull back more during a sell-off, but maybe some stocks that haven't done well. What about something like consumer staples? So if I type in consumer, Nope, I can't do it that way. It's only looking at industry groups. What we can do though, is we can click on sectors, and it's in scooter order, and it's going to be by sector. So we can go down to staples. And actually, maybe it would have pulled it up if I just said staples. I'll go back and try it in a second. But anyway, here are the staples stocks that are on the strong earnings chart list. And you can see, a few of them have scooter scores in the 90s. Chef, PM, UNFI. These are all stocks that have been pretty good relative performers versus their asset class peers. So, there's some opportunities there that are worth checking out. But what I did is I typed in consumer staples, and it's only staples. So let's just type in staples. There we go. So it does work. There are all your sector. Now, anything that says staples, so there could be something in the name of the stock that says staples, and it might be in a different sector, and it would show up here. In this case, every one of these are staple stocks. But here's the top performing to the bottom performing. And so some of these stocks at the top might be worthwhile trading if the market pulls back. Anyway, let's take a look, see what the market is doing before we wrap up. We got the Dow Jones down 78. That's 0.2%. S&P down about 1/3%. NASDAQ getting closer to 0.5%. So we are seeing maybe just a little bit more selling. Mid caps and small caps are down, but they actually are performing pretty well on a relative basis. VIX is down a little bit, even though the S&P is down. It's kind of a little strange. Maybe for the long term, a little bit more bullish. If the VIX doesn't rise when the market's going down, that really is beating us over the head that this market isn't going to go down for very long. You would think that the VIX, the fear would start building and the volatility index would be up on a down day. And maybe it does. Maybe it does turn green later. Maybe the market sells off more. But watching the VIX is also important. That's just another sentiment indicator I like to follow. If the market's coming down, that VIX goes down with it. I would not want to be in the bearish shoes. That's all I got to say. Wouldn't want to be in the bearish shoes, period. I think we go to all-time highs. Anyhow, that's all I got for today. I'll be back next Tuesday again with another show. Of course, I got this weekend show that I do at Earnings Beats. And also, if you go over to the Stock Charts YouTube channel, I do a show over there, usually recorded on Wednesdays, and it gets uploaded on Thursdays. So you can normally around midday or late in the day, you can also find the show that I do over at Stock Charts on Thursday. So be sure to check that out. In the meantime, if you do take out a 30-day trial and become part of our service, we have 5 live trading rooms every month, every Wednesday. So you're going to get 5. Some months we'll have 5 Wednesdays. Some months we'll have 4 Wednesdays, but that's a lot of time. Those trading rooms are 2 hours long, generally 2 hours long. I like to get them back to 1 hour, but they're 2 hours long, have been. So if you want more of this, where we're talking more about individual stocks and more about the overall market and if you really have a thirst for knowledge, that's what we do. We try to teach. I've learned a lot of things over the years, continue to do a lot of independent research, and I pass it along. And I can tell you, I think most of our members would agree that you're going to get quite an education with Earnings Beats. So anyhow, have a great rest of your day, everybody. Happy trading.